the CPA quite like me.
JJ the CPA here, hope you're doing well. Listen, I had a great strategy session. Actually, we call it a tactical session with now a new good friend of mine, Jim. Jim, this is for you. And one of the things that we talked about, it was an hour and a half Zoom one-on-one, was what's the value of your business? And he said, you know, you should make a video talking about this. And so here it is. What is the value of your business? So the first thing to note is that the fair market value of anything is what a willing buyer is going to pay a willing seller. And that would be at an arm's length transaction. So what's the fair market value of this shirt? Well, if I got it at Old Navy, it's probably less than if I got it at a high-end department store. What would be the difference between the price at Old Navy or a high-end department store? Well, the high-end department store is going to sell it for more. What would we be looking at why someone would want to pay more even if it was the same shirt? Well, it could be at the high-end department store that maybe it has a horse right here, right? A polo horse, or maybe some other kind of stitching that allows everybody to know that it is a specific brand. That would be, in essence, what we'd call blue sky or Goodwill in pricing a business, which I'll talk about here in a minute. It may be the same materials, but there was a difference also in the indication to the public of who made the shirt. Your business may be the same business as another business, but the reputation that you have, where it's obvious to the buyer of the quality that goes into that shirt, would then make your business more valuable. The Goodwill, the blue sky. It also can be the experience. So if I go to Old Navy, everybody says hi to me, it's friendly, kind of has a warehouse feel to it. I have to wait in line and check out, got a plastic hanger, I got a curtain that is going to go around me to try on my shirt. If I go to a high-end department store, someone probably in a suit is going to be visiting with me and talking with me and possibly follow me around and getting me a shirt to take to my dressing room, that I might get a Coke while I'm trying on this shirt, and be just a different kind of experience in also purchasing it. So in those two differences, there is what we would call, again, blue sky or Goodwill. So it could be the same shirt, but in these two different environments and the two different ways that the public would know that shirt brand would lead to the difference of the fair market value of that shirt. So think of that as your business. You might be providing the same thing as somebody down the street, your competitor, but are you or is your competitor doing something that's adding value to the basic product or service that is being provided? That is what really comes down to the differences in the fair market value of one business versus another. A lot of the small business owners out there are curious, well, what is the fair market value of my business? So I'm going to give you the nuts and bolts of it. If you have somebody come in, they would be certified in valuing your business typically, and they would have credentials to that effect. You would pay them to come in and do a appraisal, so to speak, or an analysis of the fair market value of your business. You would pay most likely at least $1,500, possibly $10,000. And that would just be for maybe a small business. Obviously, you're going to be exorbitantly more if you have a bigger business or many locations, as there would be more factors that go into that. So this is really for that small business owner that has a business that's probably grossing less than $2 million and really has one or two owners with one or two locations closely held. And this is really just giving you kind of a rule of thumb of how fair market value would be determined. So the first thing I'm going to tell you is that every business owner I've ever talked to their business is worth $1 million, or that's what they think their business will be worth when they are in retirement. Maybe, but remember, the fair market value of your business would be what a willing buyer would pay you for your business. And with that being said, there are 5 factors that typically go into determining the fair market value of your business that the hired guns are going to be using as well. So note, this is a very crude, watered down version. If you really do need a valuation of your business, most likely that would be in an environment where you have somebody that wants to buy it, and they're going to want to confirm whatever value you think that it is. Very similar to if you're selling your home, there's going to be an independent party, an appraiser, that is going to come and appraise your home. That way the bank knows that it is worth whatever it is that you're wanting to sell it for. And based on what it's worth, then of course the buyer would most likely pay whatever that appraisal amount is. But you would be able to, before you put the house on the market and you paid an appraiser $450 or $750 to come and appraise your house, you would be able to probably look around and go with what you knew you bought it for. You'd be able to come up with your own factors. So if you're determining whether or not you want to sell your business and you kind of want to get an idea up front, that would be the purpose of this. Again, this would not at all serve as a way for you to determine the value of your business to then list it. But I'll tell you this, you can determine your value using this. You can list it for what you think. The only reason that if you're actually going to sell your business that it might make sense to bring in somebody is you would want to make sure you sold it for as much as you could. This right here would be a calculation, when I say crude and watered down, this would be really for you don't have any real special pizzazz to your business. You don't have a label, so to speak, that brings goodwill, brings that blue sky value, which I'm going to address. This would be, I've got a business, and what makes it special is that I do own it, and I don't really have a special recipe or a special formula. I don't have a well-known logo, but what I do have is a regular stream of revenue that comes in at a good location or with a good clientele that's going to continue to come back. That would be, predictable. So again, if you have something special, which every business owner does, right? And you've got something in addition to what this is, then yeah, you're going to probably want someone to come and back up your value. But, I could say, hey, this shirt right here, I'll sell to you for $350. And you may look at it and go, wow, it looks really good on you. Okay, I'll give you $350 for it. Great, I just sold it for $350. I didn't need anybody to do any kind of an analysis, and I know what I bought it for. I know what it would be at the high-end store. And if I just got triple what I think it could be even at a high-end store, well, then I'm probably going to go ahead and sell it. So with that being said, again, crude, watered down, gives you an idea, gives you a feel. But what I'm going to tell you is right now, after 27 years of practice, it all comes down to number 4. So any of the businesses that I've been involved with, which are small businesses, they're not nationally known, there's no branding. The businesses that I'm talking about would be what I just described to you. So with that being said, number 4, just to cut right to it, if you were to take what your gross profit is in 1 year, that's pretty much the value of your business plus the fair market value of any hard assets that you're going to sell. Computers, equipment, fair market value of those. So what's gross profit? It's your gross sales less your cost of goods sold. What's your cost of goods sold? The direct expenses that are variable that have to be spent in order to generate your gross income. So if you were to sell a desk and you sold it for $500, but the wood and the direct labor to make the desk was $100, your gross profit would be $400. Gross profit is before rent and utilities and administrative costs and payroll for people to either sell it or help run your business. That gross profit is the net after direct expenses to sell, literally as direct as what I just said with the table. The person that's making it and the wood, that would be in essence your cost of goods sold. So that pretty much what you would do if you were selling tables and you sold $500,000 of them in 1 year, and it cost you $100,000 for the direct labor, not the salesperson, the direct labor to build it and the wood and the materials, and you netted then $400,000, meaning gross profit, then I would say your business is worth $400,000 plus whatever the fair market value is of the hard assets, tangible assets that you're also selling. In that example, the saw, the equipment, hammers, etc. That would be the value of the business. Now, if you happen to be somebody that has made a desk for a president of the United States in the past, whoa, now your value of what you're putting together is a lot more because it's somebody who has done this. So I'm talking about, again, just not your run of the mill, but just somebody that has a well-established business that sells desks and is able to continue to sell them and has established a customer base that would continue to buy these desks. But again, I'm just telling you, after 27 years, the analysis is done, they spent the money, and it always comes out to basically what number 4 is. But the 5 factors that an appraiser will look at, these 5 factors, you add them up and divide it by 5. Okay, so what do you think the value of the business is? $1 million. Okay, so we'll start with that, $1 million. What's the book value of your business would be the next thing that's looked at. What are your assets? As in assets, okay? Tangible assets. You know, if you're selling receivables, that would be an asset. If you're selling vehicles, that's an asset. If you're selling a patent, okay, that's an asset. So what are your assets minus the liabilities, okay, that owner would, the buyer would have to take on? That's your book value. Okay, so I have 100,000 in assets, I have 50,000 in liabilities. The book value is $50,000 in that example. The third one is what's the net income, and then you have a factoring of 2, 3, or 4. That's where there's some of this magic that comes into play. But I'm telling you, for most small businesses, even if you've been around a long time, the factor is usually 2. So if the net income, now net income would be the EBITDA, the earnings before interest, depreciation, and amortization. So this in essence would be the true net income, not taxable net income, because taxable net income, you deduct interest, depreciation, and amortization. That's what EBITDA is, earnings, net income, before interest, depreciation, and amortization. Interest, well, the buyer isn't going to necessarily have the same amount of loans, which means they're not going to have the same amount of interest expense. The buyer isn't going to depreciate or amortize the assets the way that you have been. So that's why those things are adjusted. Those are tax preference or tax deductions. So the EBITDA times 2. Now, you might be in a business that when a customer comes on, it's a 2-year project, or any customer that comes on, it's going to lead to pretty well an automatic 3 or 4 years worth of revenue. If you have a business like that, that then the buyer can count on that the customer that they're buying or the assets they're buying are going to, no matter what, produce more than 2 years of income, then that's when a factor of 3 would come in, or a factor of 4. Now, I've had other businesses and they're getting a factor of 12, but that's because a professional came in and took a look at it. But that was a specialty type business. So the EBITDA times 2. Then to number 4, the gross profit. So gross sales minus your cost of goods sold. What's your gross profit for 1 year? And then here's where that magic comes into play with the market analysis. The market analysis would be by somebody that is an appraiser, but also one that would have a background or an expertise knowing your industry, and knowing your industry locally, depending on the type of business and where your competitors are and who you sell to, if it happens to be in more than one state or nationally, You would want an appraiser that would have that kind of experience. Of course, the more experience that appraiser is required to have, well, then the value of that or the price of that appraisal or valuation is going to be higher. So for a small business that's in one town, you don't need to hire someone to do a national market analysis per se, unless that one business in that one town sells many other places. So with that being said, the market analysis, right? What it comes down to for me, when there's all the market analysis, it's the blue sky, okay? It's the blue sky. It's the label that's on the shirt. It's the special location that you have. It's that recipe that everybody would love to have because it's led to you putting out the product that no one seems to be able to duplicate, so to speak, or the formula, or somehow something special about your business, not you as the owner, because you're gone. That would be, quote unquote, what we call the blue sky, the market analysis. So you would add these 5 things up, okay? These 5 things, and divide it by 5 to get an average, and then that's usually going to be the value of your business. Now, if you're saying here, we're like, well, JJ, how do I come up with a market analysis? Well, if you're the only business and you're in a town and really your customers are in a town, okay, what's your market analysis? Well, really your market analysis is one of the things up here, but typically a market analysis would just be number 4, okay? Because you don't have anything really special. You just have ongoing sales that are going to occur, and that's why it would really just be the exact same thing. A market analysis for a business that has a label or a logo or something beyond just providing the product or the service may lead to a higher dollar amount, but check it out. The market analysis is based on number 4. So when I go to market analysis, if you don't have anything that's above and beyond, okay, the starting point, in my opinion, very crude description here, the market analysis starts with number 4. So if you have something extra, you'd start with number 4, and then you would add your blue sky. You would add what's called your Goodwill. That's the out of thin air, can't really touch it, value to a business that is based on number 4. The reason it's based on number 4 is that blue sky is what's driving number 4. So for the businesses I'm working with, let's just say it's a dentist or a law office that does hourly billing, or a retail shop, a salon, right? We're gonna go, what do you think that business is worth? What's the book value? Assets minus the liabilities. We're gonna take that net income, the EBITDA, times 2. We're gonna take the gross profit for 1 year. The market analysis and what I just told you would really be the same as number 4. You'd add those together, divide it by 5, and typically, okay, this is high because you're going to think it's worth $1 million. Your book value is going to be nothing, 50,000. Okay, in this example, your EBITDA is going to probably be not that huge, right? Most small businesses, let's be real, most small businesses after they pay all the expenses that they pay, the net income isn't, $1 bazillion. And then you have your gross profit. So, and you take the gross profit here, you add all those things together, divide it by 5. Add the fair market value of your assets, and that's really then what your business is going to be worth. And all I'm telling you is that after 27 years, it pretty much comes out to be number 4, your gross profit for 1 year. Yes, you might be in an industry that doesn't make any sense. That's why this is a general video. If you're just wanting a, what's my business worth? What would be a starting point? This might be helpful to you. But if you're getting into a serious amount of negotiations with somebody, yes, it might make sense to put together and hire somebody to do a professional, detailed, analyzed, certified appraisal of your business. But I'm telling you this right now, if you got a barber shop, you got a dentist, okay, you want to spend like maybe $1,500 to put something together, because what it's going to do is back up this. The other reason to maybe just get a feel is that you would also have an idea, is this even something others would be willing to buy? You might have a business that makes desks, but it's so specialty and intricate, and the inlay and the way that it's on and on and on and on and on, it may not really be anything somebody can duplicate. It may be only really worth this huge market analysis that makes you think it's worth $1 million because you as the owner made a desk for the president. You're no longer there, so that value isn't going to necessarily follow the business that you're selling. So again, just a crude way to get an idea of what your business is worth. But I'll tell you this right now, anytime a client says to me, hey, what do you think your business is worth? I tell them, I'm not certified. This isn't what you should sell it for. If you're going to sell it, then we probably want to look at this a little closer. But I'm telling you right now with the clients, if I'm doing this and we're doing a quick look to see what we want to look at here, I would be saying, well, what's your gross profit? What's your fair market value of your assets? Slap it together. There's our starting point, okay? That's our starting point to us. Doesn't mean that you list it for that, right? Because everybody's going to talk you down on the value of your practice. That's just how negotiations work. You put a price out there, somebody's going to want to pay less than that. So I will tell you this, there are owners out there, and it wasn't a client of mine, but I have a client that's friends with somebody, and they thought their business was worth $2 million and it sold for $220 million. So don't just go, well, I don't want to spend $1,500 or $5,000. If you feel like you got something special, right, not just because it's you, then yeah, it makes sense to have an analysis. You don't want to leave money on the table. But I'll tell you the last thing is that if you are going to pay somebody to put together the fair market value of your business, this at least gives you an idea of what they're going to be doing, what they're looking for. It gives you an idea maybe where the value might be coming in. If they come in with something that's lower than that, they're going to break out for you the 5 factors, and you'll be able to walk that through with them. You may not be able to change their mind, but at least you'll have an understanding of how the fair market value is being brought up. And then on the flip side, if you're looking to buy a business, make the seller do a fair market value, but until an appraisal, but until that's done or before anybody spends some money, you might be able to just do this to say, okay, they're offering it to me for this. You run through these numbers. Is it close to what they got? You might be in the neighborhood, but I'm not telling you to make any decisions here. I'm giving you a crude idea of how a business gets evaluated for its fair market value. If you were a buyer, well, what do they think it's worth the seller? What's the book value? Well, you need to see their balance sheet for you to know the book value. What's the net income? What's their EBITDA? Well, you would need their financial statements, but better yet, you're going to need their tax return. You would make the adjustments so the tax return of the business would indicate the gross profit as well, is where you're going to get that for number 4. And then with any of my clients that are buying businesses, we also want to see the bank statements for the last 24 months of that business, just page 1. That way we can see what was actually collected, what went out the door, and match that up to some of these numbers. So don't go it alone when you're buying and selling a business. If it's going to be much above $10,000, $15,000, $20,000, it's your money. Sometimes you find the fire sale. But nonetheless, hopefully this is valuable, and put together the video again for Jim. Happy birthday. And then, oh, wait a second. If you're not subscribed to my YouTube channel and you made it to here, what are you waiting for, right? I must have given you some kind of value. Hit the click, subscribe. I really would appreciate it. And then don't you ever forget, you've never met a CPA quite like me. All right, hey, have a great one.